We're going to begin our 15th lesson in a series of 19 on the truth about personal finance, what the Bible and the historic academic research say is the best path to God-honoring financial independence. Our guiding verses for this study are Job 22:21. Submit to God and be at peace with Him. In this way, prosperity will come to you. And from Hebrews 11:1, faith is being sure of what you hope for and certain of what you do not see. And from Deuteronomy 8:17 through 18, you may say to yourself, my power and the strength of my hands have produced this wealth for me. But remember the Lord your God, for it is He who gives you the ability to produce wealth. And finally, from Job 21:16, but their prosperity is not in their own hands. I'm Ron Fisher, and I'll be giving today's study. Our study today is insurance, defending against financial disaster. Our guiding verses for this particular study are Isaiah 45:7. A catastrophe you cannot foresee will suddenly come upon you. And from 2 John 1:8, watch out that you do not lose what you have worked for, but that you may be rewarded fully. How does insurance work for everybody? Insurance is your way of transferring risk from you to an insurance company. You don't want to be one of the uninsured when the unexpected happens. From Job 3:25 through 26, we read, what I feared has come upon me, what I dreaded has happened to me. I have no peace, no quietness. I have no rest, but only turmoil. The insurance company uses actuarial data using all kinds of metrics, including your age, your claim history, where you live, pre-existing conditions, how many miles you drive per year, the effect of weather patterns, whether you are bundling different types of coverage, to determine your insurance premium, the amount you have to pay for the coverage you have chosen. By combining your risk with the risk of many other policyholders, the insurance company softens the blow of paying out any given insurance claim. How does insurance work for everybody? The premium you pay is also determined by the deductible you choose. The deductible is the amount you personally must pay prior to the insurance company paying their fair share of the claim. Choosing a higher deductible, example $500 or $1,000, will decrease the premium you will be required to pay. If you have a fully funded emergency fund, raise your deductible would be a wise way of saving money on your premiums on the front end. You should not make any claim to your insurance company for any damage that is below your deductible. Repeated claims under a particular policy will result in higher insurance premiums. Just pay to get the repair completed in cash by using your emergency fund. You can find insurance coverage for almost any type of loss you can imagine. We read from Isaiah 47:11, disaster will come upon you, and you will not know how to conjure it away. A calamity will fall upon you that you cannot ward off with a ransom. A catastrophe you cannot foresee will suddenly come upon you. You only want to insure against the large financial losses that may occur, the types of events that will severely damage your financial health. we are going to examine the rationale for maintaining insurance coverage in the following categories: health, auto, homeowners or renters, catastrophe, disability, life, long-term care, and umbrella liability insurance. Health insurance. Health insurance is a necessity given that an accident resulting in physical harm can happen to all of us without notice. That, of course, is why they call them accidents. If health insurance is offered at your work, you want to take advantage of this benefit in order to be part of the group and as such pay lower premiums. If both you and your spouse are offered health insurance benefits, determine if each should stay on their own company plan or which plan gives you the best bang for your buck. Add dependents to the plan that makes the most sense for both coverage and economics. There are basically two types of health insurance coverage: a high deductible health savings plan with an HSA, health savings account, or plans with lower deductibles that the insurance company pays a percentage of the cost. Example, 90% and you pay 10%, 80% you pay 20%, 70% and you pay 30%, where the insurance company will pay the 90% and you will pay the 10% of the claim after your deductible is met. You will have to run the numbers based on your family's particular health care usage, but oftentimes the 80-20 policy is the sweet spot for value when it comes to upfront costs with adequate coverage. This policy would pay after the deductible is met 80% of the claim, while you pay as the policyholder 20% of the claim. A high deductible health plan with health savings account may be the best choice for the young and healthy. This is the type of plan to choose if you don't anticipate any health care needs, because with the high deductible plan, you will be paying for most of your health care costs out of pocket up front by using money placed in your HSA. The advantage of this plan comes with the HSA, which is triple tax advantaged. The money you place in this account goes in pre-tax. The money grows in the account tax-free and can be withdrawn without tax if used for medical expenses anytime in the future. Many employers will place money for you into your HSA each year you enroll in the high deductible plan. If you are young, healthy, and risk-averse, this may help you build health savings for use in the future years and maybe into retirement when towards the end of your life you'll need significant resources to cover anticipated health care costs. The flexible spending account. If a high deductible health plan is not right for you or your family based on higher need for health care services, consider using a flexible spending account or FSA to save on your health care costs. The flexible spending account allows you to withdraw from your paycheck pre-tax for authorized health care expenses, saving you the amount of your tax bracket on these purchases. Authorized health care expenses can include visit copays, prescription medications, health care bills such as medical imaging or lab tests not covered by insurance, and some durable medical equipment and over-the-counter medications. Auto insurance. If you own a car, automobile insurance is a must. In fact, many states require you to carry liability and personal injury protection. Let's go through the types of auto insurance coverage available and what each part of the policy covers. When it comes to liability coverage, the policy is written with 3 numbers. The first number covers injuries to each individual involved in the accident. The second number is the total amount per accident paid out in injury claims. And the third number covers damage to property covered per accident. Each of these numbers is expressed in multiples of $1,000. Rivian Stinson writes, let's look at what a good policy might look like. Let's say that you have a 100, 300, and 100 auto liability policy. This means you have coverage up to $100,000 per person in individual injury coverage, up to $300,000 maximum per accident of all individuals' injury coverage, and up to $100,000 of personal property coverage to prevent being sued for the difference of what your policy covers and the damage to the other vehicles involved if you are determined responsible for the accident. Ramsey Solutions write, personal injury protection is a specific type of auto insurance that covers hospital bills, medical costs, and a partial loss of wages if you get injured in a car accident. It is also called no-fault protection because it doesn't matter who is at fault, you are still covered. PIP must be exhausted before your health insurance will cover medical bills after a motor vehicle accident. Be aware that your insurer may have a strict process about when you must make a claim after an accident for PIP coverage to apply. Collision and comprehensive coverage are usually bundled under an auto insurance policy. Collision insurance covers damage caused when the driver collides with something, while comprehensive coverage generally covers events that are out of the driver's control. Comprehensive coverage covers damage to your car, such as in a natural disaster, a theft, damage from striking an animal, vandalism, an act of terrorism, or a falling object. The main benefit of comprehensive insurance is to give you peace of mind and financial protection if something really unexpected happens to your car. Having these coverages, along with required liability and PIP coverage, is considered full coverage. If you have a car loan, lease, or if your vehicle's value is more than you can easily replace without completely decimating your emergency fund, I recommend carrying comprehensive and collision insurance. Rivian Stinson writes, however, for older cars, the amount of coverage you need comes down to math. If the value of your car is worth less than what you are paying in annual premiums plus the deductibles, then it may be time to drop collision and possibly comprehensive coverage too. To check the value of your car, go to www.kbb.com or www.edmunds.com and type in your vehicle information. Both sites will give a range of estimates based on your car's condition. If you're still not convinced that dropping coverage is worth it, ask your insurance company for different quote combinations. My personal rule for dropping coverage is you own your car outright, your car has very high miles, 250,000 or more, it has very low value, less than $3,000, and you can easily afford to replace it. Homeowners, renters insurance. Homeowners insurance is financial protection for your home and personal belongings in the case of accidents, fires, or other disasters. From Jeremiah 4:20 we read, "Disaster follows disaster. In an instant my tents, my home, are destroyed, my shelter in a moment." It's a way of transferring risk to the insurance company to avoid financially disastrous events. Homeowners insurance also protects you from lawsuits due to accidents on your property. For most people, their home is their largest investment. Knowing the basics of coverage is the best first step towards getting the right amount of coverage. Your insurance declaration page will give you a breakdown of your current homeowner's policy. Dwelling coverage pays to repair or rebuild your house and anything attached to it due to damage from disasters such as fire, windstorms, hail, lightning, tornadoes, theft, and vandalism. From Proverbs 30:16 we read, "And fire, which never says enough." And from Matthew 24:43 or Luke 12:30 we read, "But understand this, if the owner of the house had known at what time of the night the thief was coming, he would have kept watch and would not have let his house be broken into." If you live in a coastal area that gets hit by hurricanes, dwelling coverage won't cover wind or flood damage. You need separate policies for hurricane coverage or flood damage. Other structures coverage covers things other than your house. Some examples of other structures include detached garage, tool shed, barn, gazebo, swimming pool, fence, and driveway. There are limits to how much the insurance company will pay to repair or replace these structures, usually around 10% of the total policy you have on your home. Different policies cover different structures, so make sure your structures on your property are actually covered in your policy. Personal property coverage protects what is in your home. It covers the things like clothes, furniture, and electronics. There is also a dollar limit attached to personal property to replace damaged or stolen valuables. Most insurance companies will cover your belongings around 50 to 70% of what your home is valued at. To make sure your stuff is completely covered, go through your house and take an inventory of everything. So get out a clipboard and make a paper record or use your phone to do a video log and take a few hours to inventory your stuff. Personal liability coverage is one of the best types of homeowners insurance coverage you can buy. It protects you from lawsuits for bodily injury, property damage that occurs on your property, and depending on the breed of dog, even dog bites. The good news is that the insurance company will pay for legal representation and coverage and cover the damage if you are found responsible for the accident. More good news is that personal liability coverage doesn't cost much. You should carry at least $500,000 in liability, and if you have a larger net worth, you should probably have umbrella insurance policy to protect yourself. From Exodus 21:19 we read, "The guilty party must pay the injured person for any loss of time and see that the victim is completely healed." Additional living expense, or ALE coverage, will help you pay the expenses of living away from home due to damage from an self-insured disaster. That includes things like hotel bills, restaurant meals, pet care, transportation, and even moving expenses if you're out of your home for a while. ALE won't pay for all your expenses. It only kicks in for the costs that are above and beyond regular living expenses. ALE has limits, usually around 20% of your dwelling coverage. Catastrophe insurance is a type of insurance rider that protects your home from natural disasters such as floods, hurricanes, earthquakes, tornadoes, volcanoes, and sinkholes. Some homeowners who live in areas that could be subject to wildfires would be wise to purchase separate fire insurance policies for extended coverage of their home and belongings. From Deuteronomy 31:17 we read, "In that day they will ask, have not these disasters come on us because our God is not with us?" If you live in an area where any of these types of disasters are a distinct possibility, you should strongly consider purchasing a catastrophe insurance rider. The price of homeowners insurance has increased by approximately 20% in the past few years due to increasing claims from weather-related damage. The cost of homeowners insurance ranges widely depending on such things like where you live, the value of your home, your past history of homeowners insurance claims, your credit score, level of coverage, and whether you need extras like flood or hurricane insurance. Renter's insurance. Renter's insurance is a necessity to cover your belongings if you rent or lease a home or an apartment. In the case of a fire, smoke damage, damage from automated sprinklers, or other natural disasters, the only way your belongings will be covered is if you have renter's insurance. Purchase renter's insurance if you are not the homeowner. Short-term disability insurance. Guardian Life Insurance Company of America reports each year over 5% of American workers will experience a short-term disability due to illness, injury, or pregnancy. Disability often results in lost income and medical expenses that can throw your financial plan off track. That's why short-term disability insurance coverage is a vital protection to help ensure an illness or injury won't permanently damage your personal financial plan. Statistically, 1 in 4 of today's 20-year-olds will become disabled before they retire. Disability insurance is sometimes referred to as income replacement because it pays your benefits to replace a portion of the income you lose if you're unable to work due to a prolonged illness or injury. Short-term disability insurance typically starts to pay benefits within 2 weeks of a qualifying illness or injury and covers you for a benefit period that is usually between 13 to 26 weeks and typically replaces 40 to 70% of your income during the benefit period. Cancer, pregnancy, mental health issues, and musculoskeletal diseases are among the top reasons for disability claims. Plan to select short-term disability coverage that will cover you during the waiting period or elimination period in your long-term disability policy. Long-term disability insurance. As the name implies, long-term disability insurance is income replacement coverage for a more extended recovery from approved disability situations. It pays you benefits to replace a portion of the income you lose if you are unable to work due to a prolonged illness or injury. You will receive benefits until you are able to return to work or until you reach the end of your benefit period. To claim benefits, you'll need to submit a claim along with information about your condition from your doctor. If your claim is approved, you'll start to receive benefits determined by your plan as soon as the waiting period is passed. The money is paid to you directly, and there is no limitation on how it could be spent. Since Social Security disability benefits typically are less than your regular income, it's important to have additional protections in place to help ensure your finances can stay on track if you experience an unexpected illness or injury. Depending on how your policy is written, disability insurance can replace up to 60% of your pre-tax income following a waiting period or elimination period, usually of 3 months. Your benefit period can last 5, 10, or 20 years, or even until you reach retirement, depending on the terms of the policy. Life insurance. One of the best ways to protect those who rely on your income for financial stability is life insurance. If you are buying life insurance for the first time, there are a few things you can do to make the process easier. From James 4:13 through 15, we read, "Now listen, you who say, 'Today or tomorrow we will go to this or that city, spend a year there, carry on business, and make money,' while you do not even know what will happen tomorrow. What is your life? You are but a mist that appears for a little while and then vanishes. Instead, you ought to say, 'If it is the Lord's will, we will do this or do that.'" And from Ecclesiastes 8:8, "No one has power over the time of their death." The first thing to do is to get a clear picture of your finances, including your assets, emergency fund, and financial obligations. You might want to consider purchasing enough life insurance to pay off your mortgage, put your kids through college, or income replacement for supporting your spouse. You're looking to acquire enough life insurance coverage that will give you peace of mind while providing financial stability for your family. You want to buy term life insurance, which expires after a set period of years, usually 5, 10, 15, 20, or 30 years. Term life insurance is much less expensive than whole life insurance and is a better choice to keep costs low. You want to avoid purchasing a whole life or universal life insurance policy, as it is much wiser to separate out your insurance coverage from your investments. Take the money you save while buying term insurance and invest it wisely, and you'll find yourself far ahead of where you would have been due to the underlying cost of whole life and universal life insurance. Your health and age are the most important factors companies take into account when giving you a life insurance quote. The younger you are, the more likely you are to pay a lower premium. Unhealthy habits or chronic disease that will increase your chance of an early demise could lead to higher rates. We read from Job 21:23, "One person dies in full vigor, completely secure and at ease." While your monthly cost, the premium, is often one of the biggest factors to consider, it's not the only thing you should think about when buying term life insurance. It is always wise to check the company you're considering purchasing a policy from for longevity and financial stability. Life insurance is best way to protect your loved ones in the event of an untimely death. If you are single, you do not need life insurance. If you have sufficient financial assets for your family to continue on without hardship, you do not need life insurance. From Proverbs 18:11 we read, "The wealth of the rich is their fortified city. They imagine it a wall too high to scale." Money Talks news staff writes, "For everybody else, term life insurance that will provide you with the coverage you need at a price you can afford is a must for financial security and peace of mind for your family." While the Forbes advisor gives us this advice, your rule of thumb should be most financial planners recommend you consider purchasing 10 to 15 times your current annual income in life insurance. From Psalm 48:8 we read, "The ransom for life is costly. No payment is ever enough." Long-term care insurance. Figuring out the sweet spot on purchasing long-term care insurance is one of the most complicated of all insurance types to compare rates. And long-term care insurance is expensive and getting more expensive every year. Did you know that a 65-year-old today has a 70% chance of needing some type of long-term care? Around 20% will need it longer than 5 years. Having a long-term care insurance policy will take a ton of worry off your back about your future. It'll also ease the burden off your loved ones. You basically have two choices. You can either sock that money away and invest it over the next 25 to 30 years so you can afford to pay any necessary long-term care expenses out of pocket, or you can pay an insurance company a premium to do the same and provide you with the contractual benefits. Long-term care insurance is a policy that covers costs related to caretakers who come to your home for care, assisted living facilities, or nursing home care. It pays for support for those who can no longer perform 2 out of 6 activities of everyday living. Since long-term care costs are not covered by regular health insurance, Medicare, and only for certain long-term care expenses under Medicaid, the government program for low-income people, that's where the need for long-term care insurance comes into play in a well-designed financial plan. Ramsey Solutions writes, "The average cost of a semi-private nursing home stay in the United States is $7,756 per month, and a nursing home rises to $8,821 per month for a private room. The estimated cost for care in the final 5 years of life is $367,000 for people with dementia and $234,000 for those without. On average, Americans pay a total of $172,000 for long-term care. And keep in mind, these costs are rising year over year. If you don't have a solid plan, these costs could burn up your savings pretty quickly. According to the federal data, women outlive men by about 5 years and need an average of 3.7 years of care, as opposed to only 2.2 years of care for the average man. Most policies are written with a 90-day waiting period before insurance kicks in. This means you should have savings of about 3 months' worth of nursing home care set aside to fill this gap, even with long-term care insurance in place. In order for your long-term care policy to keep pace with cost of care, you should add a 3% inflation rider. Although long-term care insurance is expensive, your premiums are tax deductible up to a certain limit. Be sure to ask your insurance agent prior to buying if your long-term care premiums are tax qualified as deductible with the policy you're considering. The maximum amount of premium you can tax deduct based on age is from age 51 to 60, $1,690. From age 61 to 70, $4,520, and from 71 and on, $5,640. Hybrid long-term care insurance. Hybrid long-term care policies are a combination of life insurance with long-term care coverage. They allow your beneficiary to receive a death benefit equal to your premiums paid if you don't end up needing long-term care. Hybrid policies are typically more expensive than traditional long-term care policies. While hybrid policy premiums are fixed, they're not tax deductible. It is recommended you apply for long-term care insurance at the age of 60 before you may acquire any health concerns that may eliminate you from being approved for long care insurance. We read from John 21:18, "Very truly I tell you, when you were young you dressed yourself and went where you wanted. But when you are old, you will stretch out your hands, and someone else will dress you and lead you where you do not want to go." Umbrella liability insurance. As your financial plan comes to fruition and your assets grow, you should strongly consider umbrella liability insurance. Umbrella insurance is liability coverage that provides protection beyond the existing limits and coverages of your motor vehicle and homeowners policies. Umbrella insurance can provide coverage for injuries, property damage, certain lawsuits, and personal liability situations. We read from Numbers 5:6-7. "Any man or woman who wrongs another in any way must confess the sin they have committed. They must make full restitution for the wrong they have done." Michaela Giardian writes, "Umbrella insurance is fairly inexpensive and is worth it if the value of your assets exceeds your auto and home liability insurance limits, and for those who have a net worth of at least $500,000. This type of insurance is relatively inexpensive because it supplements other policies and because it covers circumstances that are relatively unlikely. The rule of thumb for umbrella insurance is to buy as much coverage as your total net worth, factoring in assets like your home, cars, investments, and even your retirement accounts. And an umbrella policy protects your assets against the cost of losing a lawsuit over a car accident, a boating accident if you carry liability insurance on your boat, or an accident on your property. Since individuals with a moderate or high net worth can be a target for lawsuits. Purchasing umbrella insurance can keep your assets from being seized if a liability judgment against you exceeds your home or car insurance limits. As a result, it's a good idea to err on the side of caution and purchase more umbrella coverage rather than less. Conclusion: insurance coverage is a necessity, a necessary defense against financial disaster. Depending on your current financial circumstances, you should consider appropriate insurance coverage for your unique situation to protect yourself and family against a catastrophic financial event. As people of faith, you can be sure the Lord knows each and every circumstance that we may encounter, and He is preparing us to walk through whatever challenges life may bring. Remember the words of Deuteronomy 31:8 when it says, "The Lord Himself goes before you and will be with you. He will never leave you nor forsake you. Do not be afraid. Do not be discouraged." Action steps. When was the last time you reviewed your insurance protection? If it's been more than 3 to 5 years, schedule a meeting with your insurance agent. Action step number 2, do you have an adequate life insurance to protect your family? Review your current policy and purchase any term life insurance necessary to provide adequate protection. Action step number 3, have you accumulated enough assets, or is your net worth that an umbrella policy would be a good idea to protect your assets?